Hey traders, welcome back to another episode of TLA. If you don't understand the unique traits of different market sessions and just place trades randomly during the day, you're overlooking a crucial part of trading, the timing involved. In this video, we'll walk you through a robust trading strategy we've crafted based on ICT Kill Zone concepts. You'll learn what the London Killzone represents and how to leverage that information to gain an edge. We'll guide you in analyzing price action and market structure like a seasoned trader, pinpointing the start of kill zones, and spotting liquidity zones, supply-demand regions, and high-probability setups. If you're into mastering advanced trading principles, setup triggers, and staying consistent with a solid trading plan, hit the like button. Be sure to subscribe for more in-depth trading insights. Catch you after the intro and disclaimer. So, what exactly are kill zones? Kill zones refer to key periods during the day when heavy liquidity flows into the market, creating ideal trading setups. In this video, we're specifically concentrating on trading strategies within the London Killzone. When the London session kicks off, a significant amount of liquidity enters the market. During this time, the euro, pound, franc, and gold are heavily traded, which means currency pairs involving these assets tend to show the type of price movements traders aim to catch. The second point is that as the London session opens, fresh market participants enter, causing price behavior to shift compared to the Asian session. This often leads to the emergence of new trends visible on the chart. The third point is that the levels formed during this session carry greater significance for us. Most often, the daily high and low are established within this timeframe, setting the stage for capitalizing on high-probability trade setups. So, how can we apply this insight to our trading framework? During the Asian session, significant liquidity buildup often takes place. For instance, take a look at this chart of the euro-dollar on the 15-minute timeframe. This zone has rejected price action twice with strength. We see a long wick rejection, followed by an engulfing candle, indicating heavy selling interest. Traders entering short at this point likely placed stop losses above that wick, creating a cluster of liquidity in that zone. Now observe what happens as the London Killzone activates and fresh traders step in. Initially, price spikes upward, takes out the liquidity above the wick, then sharply reverses and targets the liquidity resting beneath the day's low. As we discussed earlier, the entry of new players during the London session changes the market's behavior, leading to fresh trends and shifts in market structure visible on the chart. Here again, as the London Killzone kicks off, there's a liquidity sweep beneath this low, followed by the market launching a fresh uptrend. So, how can we tell that this break isn't a true continuation but rather a liquidity grab? Let's go over two major indicators. First on the list, fake outs. A fake out, or a failed breakout, happens when price pushes beyond a structural level but quickly retreats back inside the range. Picture the market in an uptrend, breaking above a resistance zone. If price revisits this zone, resistance should turn into support, and we typically anticipate a bounce. However, if price slices back down through that level, it's termed a fake out, suggesting strong opposing momentum and pointing to a possible trend reversal. This kind of move is often an early clue that the breakout was simply a liquidity hunt, which is later validated by a change of character. To spot a genuine change of character, start by identifying the lowest point of the most recent swing low that led to two consecutive highs. If price then breaks and closes below that low, it signals a potential trend shift and confirms the fake out. Now, let's jump back to the chart and interpret the price action as the London Killzone unfolds. But before we continue, if you're enjoying this content and want more frequent uploads, hit the like button and drop a comment with the topics you'd like to see us cover next. Let's break down exactly what we're looking for as the London Killzone kicks in. To begin with, we initiate our technical analysis using the 1-hour chart. On this time frame, our first task is to identify the prevailing trend, as our goal is to trade in alignment with the dominant market direction. Next, we highlight critical price levels and significant swing points that could act as rejection zones. Performing a top-down analysis is also helpful for broader context, but don't overanalyze by going as far as the monthly chart. If your entries are on the 15-minute, checking just two higher timeframes is more than enough. Moving to step 2, we shift our focus to the 15-minute chart for trade execution. On this chart, we outline the key liquidity zones, especially the current day's high and low formed during the Asian session. At this point, we typically observe three familiar price patterns that tend to occur as the London Killzone unfolds. In the first setup, the market targets and clears liquidity above or below the high or low established during the Asian session. Following this liquidity grab, price typically resumes movement in the dominant higher timeframe trend. Once this occurs, we implement smart money concepts directly on the chart. This involves spotting fair value gaps, supply and demand zones, order blocks, structure breaks, and ultimately the highest probability trade setups. We then execute our entry in the direction of the ongoing trend. Next, I'll walk you through the remaining scenarios and share actual chart examples to make everything crystal clear. Just a quick reminder, before committing any real capital to trades, ensure that you've thoroughly backtested your strategy at least 100 times across various currency pairs to gauge performance and build the confidence needed to trade live. Keep in mind, though, that backtesting can be quite a time-intensive process. In the second setup, the market has already accumulated sufficient liquidity prior to the start of the London Killzone, allowing price action to extend in alignment with the higher time frame trend. Just like before, we can capitalize on the movement by merging the higher time frame bias, significant price zones, and confirmation from the lower time frame to refine our trade entries. In the final scenario, the price heads for sweeping liquidity beyond the high or low of the day that the Asian session created. Then we witness a complete shift in the market direction. Now let's see some real chart examples to show you step by step what's going through our mind when the London Killzone starts. Looking at the GBP USD on the 1-hour chart, we observe a clear uptrend in motion. The market keeps breaking structural levels to the upside, indicating strong bullish momentum. Based on this, we define the current market as bullish and will focus on taking long setups as long as price remains above the established higher low. Additionally, this recent swing high acts as a major resistance and serves as our target from a higher time frame perspective. Next, let's switch to the 15-minute chart. Keep in mind that the trend on the higher time frame is bullish, so our focus remains on buy-side setups. Here, we highlight the critical liquidity zones, specifically, the high and low of the day formed during the Asian session. It's evident that a large number of traders went long at this support level, so a typical move for major players would be to drive the price below the day's low, collect resting liquidity, and then propel the market back up in line with the prevailing bullish trend. Now let's observe how the market reacts. An aggressive entry could have been initiated by going long once these candles re-entered the range after the fake out. On the other hand, a safer approach would be to wait for a confirmed change of character signaling a reversal, and then enter on the retracement. While conservative trading tends to be more stress-free and carries reduced risk, it often leads to missed trades, a natural part of the trading process. Looking at the 1-hour chart of pound-yen, we can see the market was trending strongly upwards until it hit this zone. The price reacted to this level several times before eventually reversing, which now gives us a bearish outlook. At this stage, we have a valid short setup, and the target becomes this untouched demand order block lying ahead of the current price. Let's now switch to the 5-minute chart to identify short entries. On the 15-minute time frame, price action is forming large bearish candles with fair value gaps, signaling strong downside momentum. This marks the day's high, holding significant liquidity above. Still, the current market structure shows sufficient liquidity. A fresh, unmitigated order block has formed, giving an ideal chance to enter short in line with the prevailing bearish trend. Therefore, we can set a sell limit exactly at this order block and aim for a 2-to-1 risk-to-reward ratio. Again, we can clearly observe fair value gaps, a break in structure, and yet another bearish order block, making it a valid setup to place another sell limit while the London Killzone is still active. These were just a few illustrations of how to interpret price action and market structure during the London Killzone. Always keep in mind, patience is key. If a trade setup doesn't meet the criteria defined in your trading plan, it's better to skip it. Taking more trades doesn't guarantee higher profits, so developing the discipline to wait for quality setups and avoid weak trades is crucial. Alright traders, I hope you found value in this video. If you did, make sure to tap the like button to show some love, and if it's your first time here, think about hitting subscribe to stay updated with our content. Catch you in the next one.